Welcome to the Daily Brief, where we'll go over the highlights for the action in the market for Friday, December 16th, and then we'll see how things are looking for Monday, December 19th. We had another down day. It was also quadruple witching, which are when various options contracts expire for the month of December, and you have futures contracts and ETFs and all kinds of things. So that produces a lot of extra volume. However, it was still a pretty down day. We're kind of going with the same scenario that the market had taken on Thursday, that because the Fed isn't as likely to at least slow down raising interest rates, and they may even continue to raise them. And once they do get them to the point where they want interest rates, they're going to leave them there for a while, even though this has been a scenario that has pretty much permeated the markets in 2022. They're afraid that that's going to go through to the bottom line of companies. And now more the fixation is on the valuation of the market and the earnings per share for each individual company. So it ended up being more of a down day. All right, let's go back and talk about what happened. Right at the open, we had a gap lower open and prices fell below S1 at 38.64. Then prices kept falling down to S2 at 38.32 before rebounding back up to S1. As the day went on, we just kind of went around a little bit, but we ended up closing down below a little bit under S1. We were down 1.11% on above average volume because of the quadruple witching. And the technicals, they're still decidedly negative. After Thursday's action, we switched back more to a full-blown negative stance. We continue in that stance right now, although on a short-term basis, we're becoming a bit overextended to the downside or oversold. And I have some charts to show you. Intermediate term is still looking a lot more weak. We're not really becoming oversold or extreme negative yet, but if we keep falling down, that will likely happen because of the fixation about inflation and interest rates, really about interest rates. And that's what's putting a lot of fear into the market. So we'll just have to see going forward how things continue to play out. So here is the intraday chart, where we didn't have the gap down on Friday like we did on Thursday, but we still were down nonetheless. The futures contract during the night, they were down heavily. Even at one point, they were down over 1%. Well, we took that negativity into the open, where we went down to S1. We finally broke below S1 and went down to S2, camped along this for a little while, and it looked like, okay, are we establishing some kind of base before prices get set to go higher? Well, they did go a little bit higher, but not all that much. They came right back up to S1, hit that level of resistance, and then fell down slightly going into the close. So what are some comments? The S&P futures were negative all night and down over 1%. I kind of watched them while the market's not open. Things in Europe were not very positive, and that bled over into the U.S. market. We did have quadruple witching, and the concern right now is the earnings per share and valuation. The S&P did close below its 50-day simple moving average, which is right at about 38.64. The dollar was up in Friday's session. Interest rates were kind of mixed. We had the maturities kind of spread out, with some were up and some were down. And on a short-term basis, we have the moving average study that's looking back 20 periods. That is extreme negative in getting into oversold territory. And I have a chart to show you of that. We have the rate of change going back 10 periods. That is extreme. The McClellan oscillator is starting to get extreme negative. The PMOs that are rising, that is showing a continuation of the weakness. The stochastics, the Stoch RSI, and the Williams percent R. Those are all, if you watch the video for Friday's session, this list was not very long. Well, after Friday's session, this list is becoming longer. In the intermediate term, we just have the CCI 14 period and 20 period that are getting extreme negative. We still have all of our yield curves that are inverted, the 10 to the 5-year, the 10 to the 2-year, the 10 to the 3-month, and the 30 to the 5-year. And sentiment, because we're going down more now, it's dropped out of the positive stance and has gone back into the Well, first it switched from positive over to neutral, and now neutral over to negative or showing some fear. We had the preliminary IHS market manufacturing PMI that came out, and this is showing contraction. Whenever we get a reading under 50, that shows that it's slowing down. It came in at 56.2, where last time it was at 47.7. And then the services PMI came in at 44.4. Last time it was at 46.2. So both of these are showing that the economy is slowing down. Our trend is negative. We've crossed over. The red line has crossed above the green line, or you could say the green line crossed below the red line. And it is weakening because those two lines are close to each other. So it just shows that the ADX is still going down and is below 20. Our bias is negative and our momentum is now switched over to negative. Here's the chart, and this is not updated as of Friday. I wasn't able to find that, at least yet, but we're down below this 4,000 level and actually dropping now below the 3,900 level. So it does look to be going along the same path as this green line from 2006 through 2008. Now, it doesn't mean it's always going to stay exactly like that, but so far we have been following that same basic pattern. Another thing that we're not really seeing as we're going down is the VIX going up. That just isn't happening right now. It's still at a very low level, which shows that complacency is kind of high. Doesn't mean that the VIX is really, really low right now. It's just when we're going down, you would think that the VIX would go up, and it's just not doing that currently. Here's the rate of change going back 10 periods, showing that we're getting rather extreme to the negative side. And the equity put call ratio on the 1-day chart did not update again. I don't understand what's going on with that. But when for some reason, the 5-period chart does update and it actually ticked up a bit. We're still looking at this spike. And again, a lot of times when we get a real high reading like this and then it starts to come down, that will mark a low in the S&P. Well, that's just not happening. We spiked up right here and we've been going sideways and now we're dropping some more. Are we going to go back and set another spike with this? Here's our ADX showing the condition of our trend where you can see the dark line is going down. We're below the moving average. The red line has crossed above the green line, so that's negative. And since we're below 20, we are still in a trendless environment. And if you kind of look back a little bit, you can see this makes sense. We've been chopping sideways. Now it looks like we're beginning to drop below this range that we've been in. If that continues, you'll probably see the ADX start to turn up and eventually go back above 20. The BPI is starting to show some weakness. And I've been showing this chart for quite a while now, where we spiked up here. And a lot of times when the BPI spiked, that marked at least a short to intermediate term top in the S&P. Well, we spiked a couple of times. Actually, you could say this is like a head and shoulders top. And it's kind of loose there, but you have the left shoulder, the head, which was the high, and then a little bit lower shoulder. And now we're starting to fall down. If we continue to fall, that will probably lead the S&P lower as well, as the S&P will drag down the BPI as well. Here is our PMO studies. I showed this in yesterday's video where we're starting to get extreme negative. Well, we're even more so. The buy signals are starting to get rather extreme negative, and we're turning down with those PMOs that are above zero. Here's our stochastic. Short term, getting extreme. Not quite extreme yet, intermediate term, and now headed lower in the longer term. But again, remember, all three of these charts here are part of the short term overall, which we're just subdividing the short-term time frame. Here's the moving average study going back 20 periods with our exponential moving average starting to get extreme negative, but still could fall further than it has. 50 period going down and the 200 period also going down. McClellan oscillator starting to get extreme negative. It could go lower than where it's at right now, but a lot of times when we get into this area, that means that we've gone down a little too far too fast. Here's our double and triple exponential moving averages. We're right on top of this anchored moving average going back to the 2020 low, the COVID low, as it's often referred to. Can we get some support off of this moving average and bounce back up, or are we going to fall down below that? The daily chart, we're right down. We came down to S1. We broke below the pivot, which is more negative. We found some support at S1 on the daily chart, and we came down and broke below the 50-period moving average. That was kind of our last line in the sand, that could we maintain price above the 50-period and at least close above that? Well, right now, the answer is no. And then down at the bottom, you see this massive spike in volume due to quadruple witching. Here's our moving average tree where we drop below and then close below the 50-period moving average. So that's more kind of decidedly negative. Now, anything can always happen. We might get some bounce back up in Monday or Tuesday's session and get back above this. But the way things look right now is it's not very positive. New highs, new lows. We're seeing a real expansion in the new lows. And so 5-period is turning down and the 10-period is going down. The STO is also continuing to decline, both based on price and volume. We added another 0 with the point figure chart, and we're still working off of a generated double bottom breakdown, which was generated in Thursday's session. And it's just more confirmation that that might be happening. Here's our short-term fib where we broke down through lots of support. The next level of support on this chart is at about the 3806 level. We have a double fib line right here, 2 Fibonacci levels that are crossing over top of each other. And then longer term, we're coming back down to this other fib level at 3825, where we closed at 3852. So we're still, 25 points away or so. But if we come down to this level and it doesn't hold, that could be much more negative. The Dow, even because, let me back up. It was down again. It was down 2.25% on Thursday, another 0.85% on Friday. We're down to this S1 level. This has been the chart that's held up the best, at least through the fall and coming up into the end of the year. We're seeing a golden cross where the 50 crosses above the 200. And as long as price stays above that, this chart will just think everything is hunky-dory. If we break down below this, then you'll start to see these charts, the moving average part of the chart, start to turn down. So what's our outlook for Monday? The technicals are negative and becoming oversold, at least in the short term. Doesn't mean they have to stop, but we're just starting to get rather extreme. We have the NAHB Housing Market Index coming out on Monday, and that's it. And then the whole list of geopolitical concerns. The markets are really fixated on this interest rate, inflation, what's going to happen going forward, what are the valuations of the market, are the EPS estimates going to have to be lowered, and that's ultimately going to take stock prices down. We're still getting into this recession debate. Are we in a recession? Aren't we? Well, if we aren't right now, are we going to go into a recession in 2023? And what's that going to do to the market overall? Our scenario's kind of leaning more towards the down scenario, but we're not trending yet. And we're becoming a little bit oversold in the short term. So that might produce some kind of a bounce in Monday or Tuesday's session. You can't really go with the up scenario. All the positive things have pretty much been wiped out. Our sector rotation, that continues to break down. Our positive setups, that's continuing to break down. We're just not getting a lot right there. And these setups and charts that we use are not extreme negative right now. They're not producing an extreme reading to the downside that typically marks a bottom in the market. And our technicals are really switching more negative, but we're not trending. The ADX is weakening. It's below 20, and it just crossed over negative. So our conclusion, the S&P is negative and becoming oversold in the short term. Short-term negative, oversold, negative with the intermediate term becoming a little bit oversold. If we continue to fall in Monday's session, that will become more and more prevalent, the oversold condition. Long term, we're still negative overall because we're well below the 200-day simple moving average. Thank you. Have a wonderful weekend. This will be the only video that I post over the weekend, and have a really good time trying to analyze things, and I'll talk to you in the next video.